for this interview, we're going to discuss basically the monetary system as it's currently structured in the big picture sense. So how we got here, what's kind of built up to the situation that we're in now, and where we might be heading in the future. So for a little bit of background for the audience, basically every several decades, the global monetary structure system has been restructured in various ways. And so going back to the 1800s, we had the gold standard. As that went into the 1900s, that obviously encountered a number of issues. 1944, we had the Bretton Woods system, which was eventually defaulted on in 1971. And ever since the mid-70s, we've been in what could be termed the petrodollar system. So maybe you want to describe how you viewed that transition and how the current system works as you see it.
Yeah, absolutely. I think when the system, the Bretton Woods gold standard broke down in 1971, as you said, and it was really ultimately a function of every peg in history is broken, right? And so the dollar was pegged to gold at $35 an ounce and then $42 an ounce. And the issue was that LBJ's guns and butter programs, the Vietnam War and domestic Great Society programs, were running deficits that when as foreign creditors initially sterilized those deficits. In other words, foreign U.S. creditors were holding treasuries, holding dollars, not demanding to convert those dollars into gold at the $35 and then $42 per ounce rate. As the deficits continued to get worse and worse, however, you did start to see creditors begin to demand their gold back. And the problem was that the deficits had gotten so big that there was simply, the U.S. was going to run out of gold at the $42 per ounce rate. And so there were two options that Nixon, by that point, had to deal with the situation. The first option, which was, as I understand it, provided for me under Article 4 of the IMF, was that the United States could devalue the dollar against gold. Zylstra suggested that the dollar be devalued from around $42 an ounce to about $125 per ounce. And then that system could have continued on using gold as the neutral reserve asset. The second choice was that the U.S. could simply close the gold window, decide to stop tying the dollar to gold. And that's the option the U.S. chose. It was originally supposed to be a temporary solution. Of course, we're now 50 years into temporary. So I guess it's all just how you want to define transitory or temporary. And that brought you into the petrodollar system because initially, basically, the world's reserve currency had lost its anchoring. And it was a very chaotic time. And it effectively, you needed something else. You needed some sort of new system, something else to effectively back the dollar. And like you said, in the mid-70s, the United States and the Saudi government came to an agreement, which came to be known as the petrodollar system, where effectively Saudi agreed to only price oil in dollars. When you combine Saudi oil production with United States oil production, which up until just a few years prior had been the U.S. had been the world's biggest oil producer in the world. And so you came to this system where oil was effectively backing the dollar to replace gold at a fixed rate, which had been backing the dollar.
And I've seen you reference the Financial Times article that compared this to Dutch disease. And so for people that aren't familiar, Dutch disease refers to, essentially when a country discovers a large, say, pool of natural resources. For the Dutch, it was natural gas. And so they begin exporting that, which sounds like a great thing at first. It's all good. You found new resources. But the downside is that it strengthens your currency and therefore diminishes the value or the competitiveness, I should say, of your other exports. And therefore can actually impact negatively a lot of people in that country that are not associated with that new discovery. So how would you go about describing how this impacted the United States in terms of Dutch disease? So obviously, it gave us a lot of advantages, the United States a lot of advantages as a hegemon, but it also, there's no free lunch and it did come with a cost. So how would you describe that over the subsequent decades from that point?
Absolutely. I think you need to break that down into geopolitical impacts and then domestic economic impacts. And so the geopolitical impacts, the petrodollar deal was a masterstroke of diplomacy. Ultimately, in plain English, what it meant is that we could print dollars for oil, and the Soviets actually had to go about all of the work of lifting the oil out of the ground. And that in turn was an essential turning point in the Cold War, in my view, because what it effectively meant was that the Soviet economy, which was very heavily energy dependent, was at a disadvantage to American oil production from that point on, because they actually had to do the work to get the oil out of the ground, and we could just print the dollars for it. And ultimately, the geopolitical impacts of the petrodollar deal were that we won the Cold War. I think from that point on, the United States had won the Cold War. It just hadn't been fully marked to market. And that finally happened, call it 15, 16 years later in 1989 when the Berlin Wall came down and the USSR broke up. So the geopolitical impacts, I think, are from the mid 70s to the late 80s, early 90s were extraordinarily positive. The petrodollar system was a key aspect of the United States winning the Cold War. And as you and I've talked about in the past, Lyn, the U.S. wasn't exactly winning the Cold War in 1973. So it was a really big deal. From a domestic economic and political standpoint, what the petrodollar deal amounted to is it made the United States the Saudi Arabia of money for the world. And so to your point, it meant that those businesses involved with the dollar export business, the treasury export businesses, those industries, those cities, those regions involved with the dollar and treasury export business thrived. And so New York City, Wall Street, financial centers, Washington, D.C., those areas thrive. The other areas of the country that need that exported sort of everything else, manufacturing, industrial, etc., consumer goods, those areas suffered. And so you can see this in charts showing real wages in the United States. In 1971, when the U.S. went off the gold standard, real wages in the United States, real median wage, goes basically nowhere for 20, 30, 40 years. And that is ultimately because this U.S. dollar Dutch disease that was touched off by this petrodollar deal that was a geopolitical masterstroke for the first 15 years of it. It was not good for the U.S. middle and working classes in terms of sort of these high-paying manufacturing middle-class jobs. And so the jobs that sprouted up instead, you basically switched from an equity-based production society with a small finance component. The U.S. dollar Dutch disease meant that the finance component of the United States economy and the government, the federal government component, began to get very outsized. And so Wall Street gained economic clout, share, wealth relative to Main Street. Washington gained economic clout, wealth relative to Main Street. And so what you ended up having from the domestic economic and political side, what the petrodollar deal amounted to was basically a decision to have a giant debt-fueled consumer and government spending party for the short and intermediate term, with the likely knowledge that it was going to be a disaster in the long run. And so, again, it was a decision that was made. It made sense short term. It made sense geopolitically. But ultimately, it was always a deal that in the long run, the devil was going to take the hindmost. And so we're now we're 50 years past, like we just said. So it is now, we're now particularly in the domestic economic, domestic political sides of it, and even in the geopolitical sides, it is now, we've gone past the point of maximum marginal utility for the petrodollar system. And in a lot of ways, it's actually significantly hurting the United States domestic economy, domestic political cohesion, and geopolitically.